Hi everyone, welcome to the Meet the Manager webinar that's brought to you by Triple Point's Income Service team. The webinar is aimed at UK financial advisors. My name's Alec Hogg. I'll be your host here today. They'll be discussing some of the major trends in the direct lending space and shedding light on Triple Point's Income Service and how advisors have used it. Now in its 15th year, Triple Point is a leader in the private debt market and currently manages over £350 million of assets in direct lending strategies. Triple Point has provided funding to over 60,000 UK customers so far. Well, it's over to Belinda Thomas now to take it up from here.
Alec, thank you very much. Hello, yes, my name is Belinda Thomas and I lead the Sales and Investor Relations team at Triple Point. I'm here today with Neil Richards, who is a partner of Triple Point and he heads up our leasing and lending team, and also with Chris Lake, who is our head of credit. So definitely the right people to be talking to about Triple Point and our income service. So for those of you who aren't that familiar with Triple Point, we are an investment-led organisation who were founded in 2004. By that I mean that we're repeatedly approached by entrepreneurs and businesses who need funding. And once these are successfully passed our due diligence, we then review which product is most appropriate for that opportunity. We're 90 members strong at Triple Point and we're proud to invest funds for private clients, institutions, and also we were awarded a government mandate last year. And this investment-led approach has resulted in us having assets under management of 1.3 billion. And this is spread across 4 key investment areas. We have real estate, so property within our REIT, our social housing REIT. We also do energy and infrastructure financing, which is really for our historic VCT and EIS investors and our government mandate. We also have venture capital for our VCT and EIS current investments. And last, but by no means least, debt, being leasing and lending, which is the backbone of our estate planning service and also of our income service. So just looking at the current landscape to try and put it into perspective as to what we're all dealing with at the moment, UK interest rates are at historic lows. They're to 0.75% at the moment as the Bank of England base rate. And against that backdrop, the equity markets last quarter, so coming up to the end of the 31st of December 2018, had a pretty torrid time, leading to negative returns pretty much across the board for 2018. So really quite a brutal reminder of how volatile the stock markets can be. And with that, you have UK inflation being relatively high, and certainly higher than the current 1-year fixed cash ISA rates. I looked on Money Saving Expert this morning, and actually the 1-year fixed rate is now 1.75%, but that's still below the rate of UK inflation. So we're seeing significant amounts of money in cash ISAs and stocks and shares ISAs, but they're being eaten away in real terms once you add in that UK inflation rate. Now, on the screen in front of you will be the dreaded B word, the Brexit word. I'm going to leave that well alone, but clearly whether you're a Ramona or a Brexiteer, we're certainly in a period of uncertainty. So with our income service, it's been designed to try and give a fixed level of return, so an element of certainty in an uncertain world. The highest rate that we're offering at the moment is the potential to earn up to 6.43% per annum over a 3-year term. We know that from talking to advisors, when they're looking at doing cash flow modelling for their clients, having a fixed return over a fixed period is something that's really interesting to them. And we issue bonds daily from our income service, so this rate starts being earned very rapidly. The other thing we do within our income service is we issue bonds in tranches. That means that we know that we've got £10 million worth of capacity at this current rate. So when you're talking to your clients, you can be sure that that's available to them. So the income service, the structure of it is that the income service is a managed service. It's a retail investment product. So if any of you use our estate planning service, it's exactly the same structure as that. And the service is a simple application form, which can all be done on a single platform. So it can all be done online. What we know is that many investors sometimes don't like the online process. So if you needed a paper-based application form, we can help you with that as well. But all we're asking you to do with your clients is to answer 3 questions. First of all, to answer the length of time they want it to be invested for. The income service can have investment terms of either 1, 2, 3, 4 or 5 years. And secondly, whether interest should be paid out on a monthly basis, which again will help you with your cash flow planning, or whether you want it to be rolled up and then paid at maturity. And finally, how your client wants to hold the bond, which is what the investment results in, whether they want that bond to be held in a tax efficient wrapper, such as within selected SIPs or within an ISA. And after that, Triple Point then does the rest of the work for you. So what we will do is we will find a bond issuer, and your client will be issued with a single bond. At the moment, the bond issuer that we're allocating funds to is called TP Advancer Leasing PLC. That is a company which is owned and managed by Triple Point. So the two people sitting next to me are the people who are managing that business. So essentially, through the income service, once you've answered those questions, your client is then issued a single bond from TP Advancer Leasing PLC, and it's TP Advancer Leasing PLC which carries out the business of leasing and lending to UK businesses, and it's through that that your client has access to lending to over 60,000 businesses.
Thanks, Belinda. As introduced, I'm Neil Richards, and I head up the leasing and lending at Triple Point. First of all, I think it's worth talking about what direct lending is. So direct lending is simply lending by non-banks. That can include peer-to-peer platforms, which we are not, but it's an increasingly popular asset class. Pension funds are holding it as a diversifier against the other asset classes they use. They are attracted by the low volatility and the underlying protections. And a lot of the characteristics of the deals that we'll describe to you over the course of this webinar will look at how we have achieved diversification and the underlying protections. The secured nature of our direct lending gives an underlying protection. And I think it's also worth stressing the history. I've been at Triple Point for 5 years with a background over 30 years now around leasing and lending. And Triple Point itself has been in this space for since 2006, providing predictable, stable returns to our investors. Worth looking at how the market also describes direct lending. A review by AKG describes it as an emerging asset class with the potential to improve your portfolio returns by offering higher yields, better diversification, lower volatility. We've got great experience in this. As I said earlier, we've been doing this now for over a decade and providing those, exactly as they say, better diversification, lower volatility, and a higher yield to our investors. It's worth looking at a kind of graph of where we see our direct lending opportunity in terms of risk and reward. Certainly, as advisors, you'll be looking where to position this. I talked earlier about the pension funds and them looking to add this to a diversified portfolio of assets they invest in. And we would see this somewhere between, or AKG, see this somewhere between cash and equities. The nature of our direct lending and the nature of your investing is a bond, so it looks very much and has the characteristics of a corporate bond. So Triple Point has a rich history over leasing and lending. And one of the ways we like to characterize it is that you, as an investor, can understand what we're lending to. And we've captured this within a high street, a picture of a high street and where our money, or rather your money, is at work. Our focus is on funding of business critical assets through our leasing product, but then also providing business critical lending. My colleague Chris, Head of Credit, will talk a little later on this webinar about how we are directing our lending to businesses where that money can be used for growth, for acquisition, or consolidation of other borrowings. So the high street theme talks through a lot. So you will see a lot of the SMEs will be on the high street, will be of retail nature, and we'll talk a little bit about that around Brexit if questions come on that. But always the business critical nature. Direct lending itself, in many reviews, is generally looks at loans that are £5 million plus. We certainly are not targeting that area, and we target an area where the banks are not as active. So most of our exposures are sub £5 million. We talk here about 60,000 leases and loans, and we'll talk about how our previous experience has achieved diversification. You know, when we launched the income service, we didn't want to put all the monies into one deal. And because of our rich history, we were able to access existing deal flow to give immediate diversification to our investors. So what do the underlying investments look like? My background originally from the 1990s is within leasing, the provision of finance for businesses to buy assets. Triple Point has been active in the space since 2004, not only providing equipment finance to SMEs, but also to the UK public sector. We have a rich history in providing finance for the provision of ambulances, MRI scanners, refuse collection vehicles. We have the backbone of the UK public sector. Within direct lending, we are focusing on SME finance, on SME companies, and we are looking to finance business critical assets. We have a diverse portfolio, and a classic asset that we finance is the provision of a credit card terminal, a handheld terminal where businesses take payment by card. Small exposures across a diverse portfolio of underlying small businesses, but also that asset that is the last thing they stop paying for. You know, if they're trading, they're going to be wanting this terminal, and it provides them steady and predictable return. As an adjunct to that, we also have worked with origination partners to provide short-term finance, working capital loans to businesses. We see the banks not particularly wanting to provide overdraft type facilities to small businesses, and that has enabled businesses like ourselves and others to step in and provide that short-term working capital loan. Here we are looking at a diverse portfolio of small exposures again. We do look at some secured lending. We have a long history in financing infrastructure, be it through renewables or energy production, and we are putting some monies as a senior debt above equity to finance these project finance type deals. We have a small exposure within the service to property. It is asset backed at the moment in the current environment around Brexit. We are tending to just reduce that exposure. Certainly that will be one of the sectors that you could see certainly suffering from a lack of liquidity in the short term. And then finally we come on to loans with debentures, and this is what my colleague Chris will talk about. Is the more classic direct lending. It's what you'll see the big institutional platforms investing in, and I'll pass over to my colleague Chris and we'll talk you through some more detail.
Thank you, Neil. So as introduced, my name is Chris Lake. I'm the head of credit here at Triple Point, and loans with debentures has been a real focus of mine over the past certainly 2 years. I think it's fair to say that's where a lot of the growth in the book has been in the last 18 months or so. I thought it worthwhile talking through our approach to credit risk management, particularly with those loans, and to give a background of how we approach our assessment of businesses. So the first point I would make is that we adopt a very traditional people-based approach to underwriting our loans with debentures. We have a team of experienced lenders here who are involved in the assessment of every loan, and critically from my perspective, meet the management team behind all of the borrowers at business headquarters. We believe that gives us a real insight into the business's operations and helps us get behind the numbers to really understand the underlying strengths and weaknesses of the proposition. I think it's also important to stress that whilst we do rely on our own risk assessment of the risk, we also get this independently verified through Moody's, the rating agency. For each of our borrowers, we use Moody's to calculate a probability of default and a loss given default. So, and we ensure that those do not exceed pre-agreed levels. This provides independent assurance that the risks we're taking are appropriate. All of our lending proposals are also presented for approval to the Triple Point Investment Committee, which is made of a number of very experienced business people. And that ensures that every deal is subjected to an assessment outside of the lending team and gets a so-called fresh set of eyes. Final point I'd like to make is that for all of our deals, we do require borrowers to report regular financial information and key performance measures, so-called financial covenants, on a regular basis. We monitor these closely to ensure that all of our borrowers maintain a satisfactory risk profile and we can catch any signs of deterioration early. So to summarise the approach that we take to risk and the types of deals that we do, I would call them traditional and in line with the approach that banks have taken and done very well for decades prior to 2008 and 2009. We believe it's good lending, and we believe that it provides a solid return for our investors.
Brilliant, thank you. I'm just going to flip back to those underlying investments. So just to re-clarify, with the income service, currently all funds are being allocated into bonds being issued by TP Advancer Leasing plc. And the pie chart on your screen at the moment is a snapshot in terms of how TP Advancer Leasing plc was positioned at the end of December. So Chris has very kindly just been talking through the loans with debentures category at sort of 29%. 30%. So these allocations will change over time, but really what we're seeing is a lot of opportunities within that loans with debenture category. So in terms of the service, we have two sets of rates for it. What we're trying to do is we're trying to support advisors. So if a client comes in who has been advised, we then offer slightly higher rates, which are now on your screens at the moment. If someone comes into the service direct, then the rates are typically 50 basis points lower than the rates on your screen at the moment. One of the questions that we often get asked about the income service is obviously what fees there are, and slightly tongue-in-cheek on the slide in front of you, you've got a 0% initial and ongoing. Now, I say tongue-in-cheek, that's absolutely true. There aren't any fees for the service, but of course, Triple Point does want to get paid for the work that it's doing. The mechanism that we're paid is that we are the equity shareholder in that bond issuer. It means that the bondholders are paid out in full before Triple Point earns any money whatsoever. So we have 100% skin in the game. And our track record is that we've made 100% of payments in full and on time. Advisor facilitated charging is available in terms of an initial fee. So if that's of interest to you, then we can absolutely look after that for you. What I wanted to do is I wanted just to take you through two examples as how advisors have used our income service to help their clients in two slightly different ways. So really, this was an idea from an advisor where they just wanted to make a client's capital work that little bit harder, to try and stretch it a little bit more, and they were doing cash flow planning. Now, with this case, they had a married couple who wanted to have a 2-year life insurance policy, which needed to be paid for on a monthly basis over that 2-year time frame. Now, forgive me, the numbers are quite specific because it's a real case, but they needed to be paying out £108.65 per month. Well, the traditional way to do that is really just to take money from a bank account and pay for that policy. Now, that would have cost just over £2,600. What they chose to do was to invest a specific sum into the income service in a 2-year bond, so a 2-year investment term, which under our current rates is a return of 5.75%. It meant that the bond itself was then providing that monthly cash flow to be able to pay for the insurance product, but then at the end of the day, the capital is coming back at maturity. So yes, you are tying up those funds for that 2-year period, but in essence, because you get the capital back, you're able to sort of work that money a little bit harder. And we know that that advisor found that really helpful and useful. Another side that we find that advisors are interested in is just looking at the fact that, again, those returns are getting eaten away by inflation and wanting to try and make sure that the spending power of their client kept up with inflation. So in their first scenario, they just had a cash ISA, which was putting the full amount in a cash ISA. Yes, they would have good access to that because I think that's just a 1-year fixed term in terms of that rate. But the real return of that meant they were actually losing value in real terms because inflation is higher. So the suggestion they came up with was to put 1/3 of the funds into the income service to make sure the returns kept up with inflation. So by putting a portion of the funds in, they were able to gain a better overall return for their clients. And they're just two ideas that advisors have brought to us so far, and I'm sure there are a plethora of other ideas that you could use for your clients. So in terms of the income service, like I said earlier, it is all done through an income service portal, so it can all be done online. In that, you can refer your clients, you can track their performance as well, and just look at any advisor facilitated charging on it. It's very It's very user-friendly. When you log in, a little question bounces up asking whether you're a financial advisor. Clearly, if you are, then you click on that button and you'll see the appropriate rates. If your clients are not comfortable with online platforms, then do just give us a shout and we can help you out with paper-based literature and forms. So in summary, really, why should you consider the income service, the Triple Point income service for your clients? Well, I think there are 6 reasons. The first is that the returns are fixed and over a fixed period, giving you an element of, well, giving you certainty about knowing what return we're targeting and enabling you to try and keep pace with inflation, given the rates of return that we're on offer at the moment. The bonds are issued so that each bond holder has a fixed and floating charge over all of the assets of the business. So again, we have 100% skin in the game in that they have that security. Direct lending, or leasing and lending, which is the way that we approach it, is an alternative asset class. It's not new, it's just that historically it's always been the preserve of institutions and banks. But by adding this into your client's portfolio, you're adding diversity into their book. It doesn't move, its returns aren't dependent on the equity markets, therefore it's a nice uncorrelated asset class. The bonds themselves can be held in selected SIPs and ISAs, so you do have that ability to be earning the returns tax-free. And also, Triple Point's a very experienced manager. As Neil was saying, we've been doing leasing and lending since 2006, and we have a really strong track record of consistently delivering on-target returns. And finally, I think it's a relatively simple product. It is just that service, which once you've answered those 3 simple questions, your client then ends up being a bondholder, having a single bond, which then gives them access to a very broadly diversified portfolio, which is run by the business underneath. So hopefully you see it as being a simple product with a plethora of uses. The important information is on your screen at the moment. There's always the compliance slide. I'm just trying to look through on the screen at the moment to see whether we've had any questions, and I can see a couple have come through already. So let's have a look at the first one. First one I can see is, what sort of clients is the income service suitable for? Well, I'll answer that. So they're on mine. In terms of who it's suitable for, it's a very simple, broad range of people that it's suitable for. So obviously, clearly, it's suitable for individuals. We can also accept trust applications as well, and also corporates. We have quite a few corporates who are placing funds into the income service where they don't need them in the next year or 2 years, and so therefore they're trying to get a better return from their cash holdings, taking up a better rate, given they know that they will have illiquidity for that investment holding period. We've also been asked about the diversification profile of the income service and whether there are any maximum concentration limits.
I think that's one for me then. The range of businesses that the service lends to varies from the small high street, where we're providing the credit card terminal, and there our typical exposure to that SME will be £800, varying all the way through to the lending that Chris does and his team, where typically in advance at the moment we see a maximum exposure of about £2 or £3 million. The idea is to keep our diverse portfolio. Diversification is one of the great mitigants of risk. We are lending to SMEs. There will be bad debts, but if we can spread that risk, this is classic portfolio theory. As a maximum concentration limit, we would never see our exposure to any one particular customer going above 10% of the portfolio. And I think over time, Chris, we'd see that trending towards 5%. Definitely.
There's an easy one that I've just read, so I'll definitely answer the next one. And that's, what is the minimum investment that can be made into the service? The minimum is £10,000. The next one that we've been asked is, why is the income service a good alternative to stocks and shares and cash ISAs in this current economic climate?
I'm not sure we can say it's a good alternative. I think it's a part of a balanced portfolio. And I think you see that in direct lending at the moment. And I've talked earlier on about pension funds looking at direct lending as a major asset class. And they see that as a diversifier to their portfolio. So before, it has a characteristic of a corporate bond and a well-managed direct lending asset class is a great diversifier to your underlying portfolio.
So in the webinar, we looked at the risk reward profile and how to position it. And I think it is clearly, because of the illiquidity, it is more risky than cash. Obviously, we're not trying to say that the income service is an alternative to cash, but it is something which can fit in a balanced portfolio and give you those benefits of being at a fixed return over a fixed time frame. If there are no fees, how does TriplePoint make a profit? So I suppose that comes back to when I was talking about how we are the equity shareholder in the bond issuer that the income service allocates funds to at the moment. So being the equity shareholder, it means that our return is the difference of the profits of the business after all of the bondholders have been paid out in full. So that's where we earn our return from it.
I think it's also worth adding on to that, Belinda, that's what differentiates us from a peer-to-peer lender who operate a platform, who earn fees but do not have a particular interest or a particular loss if an underlying deal goes wrong. We will not earn any money if deals go wrong. We are truly aligned with our investors, and it's important that we manage risk to, one, give the fixed return to our investors, but also to guarantee the return for ourselves.
We've been asked a Brexit question. So with the current uncertainty of Brexit, do you see opportunities in the SME lending market moving forward? That's definitely one for you two.
Go on, Chris, please. Easy question on Brexit.
Easy question on Brexit, yeah. Well, it's not going to come as a shock, but we do obviously consider the implications of Brexit on all of the potential deals that we look at. It's obviously a common occurring theme. I think our fundamental point, our basic point, is that good business is good business. An awful lot of the counterparties we've dealt with have traded through and faced headwinds previously and come through them successfully. And good businesses and good management teams will find a way through Brexit. But we are definitely very conscious of it, definitely very mindful of it, assess any potential impacts of it. But there's still plenty of good businesses out there that we feel are suitable to back.
I think it's worth going back to the last crash and looking at 2002, 2008 and 2009, which I'm unfortunately old enough to know well, and actually 2 or 3 crashes before then. But good businesses did survive. You saw the crisis the banks went through, but actually the crisis for the bank was the result of bad lending. We're well aware of them investing in subprime US mortgages. That's not what good direct lending is about. It's not what good banking is about. And that sort of lending is the thing that will suffer Brexit. I think it's also worth just looking at confidence. Those sort of markets where consumer or investor confidence is important, I suspect that we can see a little bit of that already around the Brexit uncertainty. And we allude back to our earlier property comment. Certainly across the southeast of England, which has been a property bubble for a while, we see a slowdown in that market, and certainly a slowdown generally in larger properties. Our evidence is that a property for a reason above 600,000 is beginning to stick in the southeast market. Yeah. So you see those Brexit effects rippling through the economy, and we might look at those businesses that have international exposure, of which we have none at the moment, or those that are particularly reliant on credit assurance. You go back to the failure of Carillion last year, where you can see the importance of that, where suppliers cannot get credit insurance against the underlying counterparty, that causes problems. Yeah.
Okay. We've been asked, how often do we report to clients? Because it's an online platform, clients can look at their bond and its performance whenever they like. We send them, there's a 6 monthly statement which goes up onto the website for them. We also send tax information, which again, they just need to go onto the platform to be able to see that. But if anyone wants to have additional details on their bond and how the company is performing, then all they need to do is just to give TriplePoint a shout. But that's the reporting that we have for them. We've also been asked about the level of bad debts which have been seen by Advanced Leasing PLC. Are you able to comment on that?
We have no bad debts today. Within that, within the underlying terminals, lending, the service has piggybacked off our existing Navigator service. Within that, you do see bad debts. These are small businesses, often startups, and we have an expected level of bad debt within that. But that is priced within the yield, effectively, that's charged on the provision of that terminal. We don't see that increasing, and that is been providing a return back to the service of consistently around 8% over the last 3 years. I think it's also worth saying that I've done that particular sector of business since 2002. Chris, you see in your direct lending, your lending to businesses, larger exposures, maybe worth talking about the monitoring that we do.
Yeah.
And whilst we've not seen bad debts, we will see perhaps some variability in profitability.
Yeah, sure. So I think in terms of the monitoring, the point I made during the presentation, I would make again is we pride ourselves on staying very close to our borrowers. So we insist that they report quarterly information, actually because of the strength of the relationships. We feel that management teams like to report to us and like to tell us what's going on. And not only do they report, but we also set minimum hurdles that they have to have met from a profitability perspective or a liquidity perspective. So we can spot early on signs of deterioration. So that gives us a really good control. I think also from a risk mitigation perspective, the terminals financing gives us a real view and a real indicator on sector exposure. To have exposure to that many counterparties, you can see trends, and that gives us the ability to tweak our underwriting, know what sectors are showing signs of stress or not showing signs of stress. So I would feel that we have a very robust monitoring and a very robust assessment of our existing book, and we stay very close to it, which should mean that we minimise bad debt losses.
I think it's worth stressing this isn't tick box monitoring that I think certainly the banks would have been guilty of in the past. You receive a compliance certificate from your borrower who says, yeah, I've done everything you said to do. The bank manager says, yeah, I've received it, and sticks it in the drawer. Yeah. We do actively review due diligence, and continuing monitoring is very important for us. And we internally will have monthly monitoring meetings where we go through all our large exposures and details, looking at the reporting.
Okay, I think there's one more question, or I'm not sure. There's one question which is, sorry, I'm just trying to read it. Does one have to invest via a financial advisor, or can it be done directly with Triple Point? You can come in direct to Triple Point. We would always advocate using a financial advisor because we think that people should have advice for them. The benefit of coming in through a financial advisor is, of course, that you're having those higher rates. So typically 50 basis points higher. So we would say it's probably better to come through an advisor. And I think that's all the questions that we've been sent in. So I suppose it just remains for me to say thank you very much for listening into our income service webinar. If you do have any questions that you're thinking of now, or if you want to take things forward, then please do drop us an email. It is contact@triplepoint.co.uk, or do call any member of the sales team, which is 0207 201 8990. Thank you very much.
Thank you.